Welcome to Legendary Exits, conversations with purpose-driven entrepreneurs. In this series, we sit down with the leaders and legends who turned their exits into opportunities for impact. We explore living lives of significance, leveraging exits to fund personal and financial goals, and building a best-in-class business along the way. You ready? Let's dive in.
Welcome to Legendary Exits. I'm Micah Brandenburg. I'm your host. I'm so delighted to be with Jackson Payne today, exited CFO from a family generational business, currently a business broker and M&A advisor. Jackson, it's so great to have you with us. Looking forward to this conversation.
Yeah, Micah, thanks for having me.
Wonderful. Well, hey, you have got an amazing background that I think is really relevant to clients who we work with and folks who follow the show. And that is, not only do you sell companies today, but you actually were in a family generational business and have had your own exit. So tell us a little bit about you. Tell us about what you're doing now. Tell us about, whatever you want to share about your own personal life, but then obviously want to get into, how you got to what you're doing today.
Yeah, and actually I've been on all sides of the deal, which is kind of my superpower, if you will. So my introduction to this world was selling a family company back in 2014.
Okay. What kind of business? Just as an orient us?
Manufactured oil field products. And we did not have representation. So we didn't have a Viking in the middle. I was in my 30s and thought I was pretty smart. In reality, oil was $100, so we were selling a product because of that. But so we negotiated a deal that ended up it was the most expensive education we ever received. We didn't get enough cash in the deal. Took a lot of rollover equity, and it was in the summer of 2014. And in the fall of 2014, the price of oil fell off a cliff, and so our rollover equity was pretty much crushed. But long story short, that got me interested in this space. I'd gone to business school right in that time as well in Chapel Hill, flying out every Thursday. I lived in Texas at the time.
Okay.
And that led me into just a real unique or a real deep interest in helping business owners. But from there, I actually worked at a family office for a little bit, buying deals, everything sub 50 million. So my whole business career has been in that small business space, call it $50-75 million of enterprise value and below. But then through time, I didn't really like that side of things, migrated back to South Carolina, where my wife is from.
Got it.
And I did what you're doing for a while, where I help people plan for an exit, just one or two clients plan for an exit. And that led me into Viking, where, that sounds like fun to me. And when I'm in a deal, I understand what each person at the table is thinking, at least on some levels, because I've done that. I've sold, I've bought, and then I've obviously represented. This is, for me, the funnest side of the table.
Wonderful.
Because I can take some of the things I learned and pass them on and help the clients, but also understanding what the buyer thinks. I can see around the bend a little bit, and I understand how a deal is going to how it's going to be done, what we're going to need to do, and how it's going to be structured, and all of those important topics.
Yeah. Orient us real quick. You've thrown out the word Viking mergers and acquisitions. Tell us real briefly who the company is and what the markets are that you're particularly working in.
Yeah, sorry about that. Yeah, Viking mergers and acquisitions. We've been around for 29 years, headquartered in Charlotte, North Carolina.
Okay.
17 offices now, spanning from DC down to Miami over to Texas. I helped open the Texas office. I live in Greenville, South Carolina.
Wonderful.
Helped open the Texas offices, and now I oversee the Atlanta office. So
Wonderful.
We are in the major southern cities.
Wonderful. And give us a sense, what kind of companies are you guys representing and selling? Is there any rhyme or reason in terms of industry sizes, that sort of thing?
Industry agnostic. Size, we have two buckets of deals. We've cut our teeth as a business through 30 years on business brokerage, Main Street deals.
Okay.
We call business brokerage a $1 million deal to a $5 million deal. That is our minimum, is $1 million.
Okay.
The reason we do that is because the SBA limit is $5 million. And typically the buyer of that business is an individual taking out an SBA loan, putting down a down payment and buying the company. Yeah. You get above $5 million.
Just to jump in and clarify for those listening, 1 to 5 million in enterprise value, 1 to 5 million
Enterprise value.
sales price, not necessarily 1 to 5 million in revenue. Is that a fair statement?
That's exactly right.
Keep
Exactly
going.
right. And then above 5 million in enterprise value, you typically are not getting an individual buyer. So that falls in what we call mergers and acquisitions that everybody, M&A, the buzzword out there. That's usually a strategic buyer, family office, private equity, things like that. More sophisticated
Cool.
buyers, and it's a different funding source. And the deals are done. They're similar, but they're a little bit different.
Hey, Jackson, I want to go back to part of the intro where you said that you had a really expensive lesson in selling that family business back in 2014. Without going into all the details of the process, now you've got the benefit of hindsight. What is it that didn't, like if you had representation or you were able to apply what you know today, what would have been the different outcomes you would have experienced? Would it have been more money? Would it have been a higher percentage of cash up? Walk us through that.
Yeah, the biggest thing is a lot of business owners are fixated on the value, the enterprise value. I'm selling the business for such and such amount.
Okay.
Well, there's a structure to a deal. There's terms of the deal. What is the cash amount that you're getting at closing? What are you holding in a seller's note? What is rollover equity? Rollover equity is when you take some of that purchase price and essentially buy into the new co or to the mothership of the new co, whatever they're offering. And so we were fixated and argued over the enterprise value. We got what we wanted, but we got their terms. And those terms, I mean, we couldn't foresee the future. Had the oil price not fallen off a cliff, maybe it would have been okay. But
walk us through percentage-wise, how much in your particular deal was cash versus a seller note versus the rollover equity, just to give us context.
It was, we probably had less than half cash. That was that's a whole nother topic. I'd rather not go down that trail.
One of the pieces, a quick follow-up to that, I always say to people is, the one thing you can bank on in a deal is the cash you get up front. So clearly, you had macroeconomic factors that influenced all this follow-on money. Is that sort of the takeaway?
That's exactly right.
Walk us through that.
The things we couldn't foresee. Had the oil price stayed at $108 or whatever it was, it probably would have been okay, but you can't foresee the future. And think about all the things we've seen in the last 20 years, whether it's a COVID or some war somewhere popping up that changes the environment, and you can't foresee that. So now it's important to understand, which we will get into in a minute, that you don't, very rarely do you get all cash. There is going to be some structure, but sometimes the enterprise value is not the only thing you need to look at, right? And I think that was my takeaway is an introduction to that world. And I'll add to that is that after having been on the buy side and I understand what they're looking at and I understand how a deal gets done, and now I've done doing this, obviously, I need to properly communicate that to the client that, hey, this is what we think the deal looks like. Before we even go out to the market and talk to people. And we're usually pretty close. The market speaks sometimes, but most of the time we're pretty close, and we need to be on the same level of expectation of what we're going to see.
I love what you've talked about, because one of the things that I'm always talking with our clients about is the fact that if we're really going to build a valuable business, one that's valued at more than 5 million, because you've talked about that break point, converting from business brokerage to M&A advisory, you're probably not going to get all that money up front. In fact, the more valuable the business you build, you're probably going to get a little bit lower percentage up front. So that's really great. Well, let's go there. Let's talk a little bit about deal structure, because you've talked about it in your own story that it's not just about price, it's about terms. Walk us through deal structure at a super high level. Is it 2 things, 4 things, 7 things? Just give us a top view of what should an owner be thinking about in terms of deal structure before they go to sell.
Okay, yeah. Well, and I think before that, we should back up one step and just mention that most deals are cash-free, debt-free, which means the cash in the bank, that will be yours, but you will pay off the long-term liabilities.
Got it.
So or some people call that net cash. So that is yours, and that's important because some people stock a lot of cash in the bank. Well, you're going to get that. As far as the structure of the deal, we talk about enterprise value. So let's just use easy math and say $10 million deal. I would, and let's say it's a standard 5 to 6 multiple. If you throw a dart at a wall, a lot of companies are falling in that space. Let's say 5 multiple. We have 4 buckets that we usually refer to of what we call deferred money. That's money you are not going to get at the closing table. Number 1,
Right.
seller's note. Seller's note means they owe you the money. They definitely owe you the money.
Yep.
There's an interest rate tied to it, and it's going to be paid out over time. Second bucket would be an earnout. An earnout, and these are in no particular order. An earnout
Sure.
is we'd like to stay away from them because they're highly, I guess there's a lot of variables. So an earnout means you will get a such and such a payment in the future if the company hits these
Yes.
number of metrics, EBITDA metrics or
It's
revenue
performance based. So rather
Performance
than it being a
based.
certainty like the seller note, it's contingent on the company hitting certain performance metrics.
That's right.
Is that fair? Yeah.
And that's raw with a whole host of risks on both sides. It really only makes sense when the company is really growing, and it's hard to pinpoint the value today, and the seller's willing to put their money where their mouth is, and do an earnout. But that's what an earnout is. The third
Cool.
bucket is rollover equity. That's where you take. We just talked about this a minute ago. Some of your purchase price goes into buying shares in a new co, and now you've got a partner.
Super
And then-
super common, particularly if you're getting acquired by
common.
private equity. Yep.
Very common.
Keep going.
And then the fourth bucket is escrow. And that is similar to, it's like due diligence insurance for the buyer. They hold a little bit aside for typically a year or 18 months. And if something comes out along the way that they didn't know about, they can claw back against that escrow.
And specifically, this pertains to the reps and warranties in the purchase agreement, correct?
Correct.
Yeah.
They could say, hey, you didn't tell us about this. I'm just totally making this up, but you didn't tell us that this key person was thinking about retirement. Sales have been hurt. We're clawing back some numbers. We're seeing less of that because if there's a seller's note tied to the deal, I will tell the buyer, you've got a seller's note. You don't need an escrow.
Yeah.
But those are the 4 buckets of what we call deferred money. Now, with a standard, down the middle of the road 5 multiple, we would tell people to be prepared for somewhere around 20% deferred money.
Okay.
And you mentioned it a minute ago. If it's a 7, if you're getting a 7 multiple, maybe that percentage goes higher.
Yeah.
And it's been our experience that buyers don't particularly care which bucket it falls in. They just want some skin in the game. The biggest risk is that first year or so, where there's a transition from the seller to the buyer. They could do their due diligence, but there's no way of knowing exactly how much is in that seller's brain, and when they walk out the door, what's going to happen. So they want to economically tie that person to the business, and so this is the way that they want to do that.
Part of the way that I think about the 4 that you just laid out is, seller's notes and rollover equity is a way for the buyer to fund the purchase price, whereas earnouts and escrows are really about risk and performance. Would you agree with that sort of perspective, or do you have a different take on it?
Yeah, I think that's right. I mean, in a 5 multiple, the buyer needs help financing the deal. 97% of all deals use financing, and a 5 multiple does not cash flow at the bank, right? So they need some help with. There's equity from the buyer, but the seller's got to have some in the game too. Through typically sellers don't or rollover, and the earnout is only if we're expecting a bigger, year that in the future than we've had historically. But yeah, I think that's accurate.
Awesome. So you just walked us through one element of deal structure, and that is, when is the cash being paid? Is it guaranteed to be paid? Is it upfront? Is it deferred? Because you just walked us through 4 different deferral options. What else is part of deal structure in terms other than deferred money?
Well, I mean, you've got the transition of the seller as the biggest one that people are going to be concerned with, which is that's a big risk for the buyer, right? So if I have a seller that tells me they want out in 6 months, well, that's going to affect your multiple. Multiple is a function of risk, right? If I have a lower risk, I'll pay a higher multiple, and vice versa. So if I feel that there's risk, this client wants out in 6 months, well then we'll pay a lower multiple. I usually tell people, this usually works, is look, tell them you'll commit to a year. Even if the seller tells me I'm willing to work for 5 years, tell them you'll commit to a year because we don't know what they're going to be like on the other side of the transaction.
Yeah.
You don't know you may not know what it's like. You've been your own boss for a long time. What's it going to be like taking, orders from somebody else? And so sign up for a year and tell them if we have a good relationship and I like this, I may be willing to re-up, but don't commit more than a year, but don't commit less than a year because less than a year is going to affect the deal. I would say that's the biggest topic that both sides want to know about.
Yeah, because again, I think two common misperceptions that I see in owners that even we work with and we start to educate them because they're 3+ years out from an exit is one, on closing day, they're going to walk away from the company. And two, they're going to get 100% of the money up front. And so we've just talked about two of the topics and you've given us real world experience on how the fact that pragmatically isn't generally true. So what else? Any other elements of deal prep before we move into how to maximize the deal, particularly in net proceeds? Any other key elements of deal terms that you would want to share with the audience?
I think those are the main ones. I mean, we can dive into those a little more. A lot of people want to ask, what does the seller's note look like? What's the structure of that? What are the definitions in an earnout? I don't know if we want to go down those rabbit trails, and we may have to edit that out, but those can be complex topics.
Well, I'm going to serve you up a question here, and that is this. Jackson, clearly you do business brokerage, you do M&A advisory. What is the ideal time frame for a client who wants to sell at some point in the future to be connecting with a professional like yourself who's actually going to represent and sell the company? Is it 3 months in advance? Is it 3 years in advance? What is sort of the sweet spot and why?
Okay, that's a little bit of a loaded question because it kind of depends, right? Most of the questions you ask me, that's the answer. It depends.
Sure.
If they
give us your opinion.
Somebody,
give us your perspective and why.
If they call me when they're absolutely ready to go, it's harder. Not harder for us, but it's harder to there's no time to prepare them. Well, we're not guys that will prepare you. That's people like you. All right, we're not doing that work. But if they haven't prepped it, they could be leaving some things on the table.
Let's go there. What are the common issues that you're seeing? Somebody calls you and they say, I'm ready to exit the business within the next 12 months. You start to get into the deal and the conversation. You say, they're not going to maximize here because they didn't do this, this, and this. Give us 3 or 4 key examples of what you're looking for when you say they haven't prepped the company.
The number one thing I'm looking for, and I don't know if it's more of readiness, not necessarily maximization, but that's, have they built out a staff? Do they have an org chart? What does that look like? Have they properly replaced themselves and worked themselves out of a job, right? Typically when you're getting up above $5 million of enterprise value, that's at least happened to some level, but how much have they done that? How many processes, what's their processes like? Do they have that built out? And then the books. It's amazing how many issues we have that we see with people's books and records. And there's a couple levels of that. Number one, these are sloppy. I can't make out what's what. Heavily cash basis, geared towards minimizing taxes. Well, cash basis, as you know, as finance folks like us, cash basis is not a great representation of what the business is doing. It violates the matching principle on accounting.
Exactly.
And buyers really care about what the gross profit is, and they really care about what they're actually making at least per quarter, right? And so when you do cash basis, it becomes incredibly difficult sometimes to even know what the gross profit of a business is if they're not capitalizing things correctly. They're just dropping things in as they drop into the bank, right? So I think that is a big one. As an example, if I'm a manufacturer, and we had a company a couple years ago, a manufacturer, they're growing like crazy.
Okay.
Great problem to have. Where's my cash going? Well, your cash is going out the door first to buy your material and to pay your workers, the labor.
Yes.
And then you sell it, and then you collect it 30 days later. So if it takes you 8 weeks to build it, you're floating that cash for, call it 12 weeks. And your costs are accelerating faster than your revenue because you're doing everything in cash basis. So we had them talk to a fractional CFO, start putting WIP on the balance sheet and do all that properly. And that added about...
Which stands for work in progress. For
work
those
in progress, right?
Continue. Yep.
And it means as I buy my material and pay my workers and accrue those costs, I'm not putting them in cost of goods or expensing them. I'm capitalizing them, which means I'm putting them on the balance sheet as an asset in WIP. And so it's not increasing your EBITDA, it's just properly showing your EBITDA, which in this instance increased the value by over $2 million for the seller just by proper accounting.
Just to be clear, in that particular situation, you are increasing your EBITDA in the way that it shows up on the financial statements.
Correct.
Do you agree?
It's an accounting choice. That EBITDA was there somewhere, just not getting counted properly.
Exactly.
I think we had them at about a little under $2 million of EBITDA, and with $680,000 or so of WIP, that goes right to the bottom line.
Yeah. The point that I think you're calling out to us is this point, Jackson. You can have a great company, but if you're not doing things the right way to meet the expectations of a buyer, you're not going to get credit for having a great company.
Or you lose some of the word maximization is not happening, right? So I think that's the biggest thing that we run into is accounting issues. Even if the accounting is done properly by a bookkeeper or a CPA.
Sure.
By the way, this is important for people that are heavily relying on CPA for day-to-day stuff. CPAs they're taught to minimize your taxes. When you minimize your taxes, you cost people like me a little bit of a problem getting you that value back, depending on what we're talking about. So that's a whole nother topic. But I would say accounting is the biggest issue.
Yeah. So 3 issues you brought up for us, because I was asking you, hey, they haven't prepared in advance. What are the top 3 issues? You said staffing, really around owner dependency, reducing owner dependency. Can this business run on its own? 2, do they have good processes and systems in place? 3, is the accounting and financials up to date? Super important. Why? That becomes the foundation of what people are going to look at to determine value, right? So 3 really great insights there. So and
I want to add one more to that.
Go for it. Yes. Yeah, go for it.
Extremely important, and it will help just get a deal done. It will affect the multiple too, but sometimes it's just getting the deal done. Is a lot of small businesses don't have great reporting in place, and I'm not talking accounting. I'm talking another level of KPIs, like what percentage of bids do we win? What's our job cost? All these kind of things. And if the buyer will ask a lot of questions. And look, if they don't track it, we'll tell the buyer, look, they don't track that. But the more that they track, the less risk the buyer sees, because I can see all this data, all this information.
And those are great ones you gave out. And I'll give a 102 level 1 for reporting and accounting, and that is gross margin by product line and by customer.
Yeah.
And when you have that ability to measure gross margin by product line and customer, a lot of opportunities abound to really drive performance in a much better way. That's one of the things that we're always seeking to do with clients. Great. So 4 different things you walked us through. So if a lot of folks aren't, maximize, so how far in advance should people be thinking about these topics around owner dependency and processes and books and in reporting? Because clearly you're getting phone calls from folks that haven't done that and they're not able to maximize. So what's your perspective on that?
A couple of years, and I'm talking about an M&A deal, $5 million and above. I need at least 1 clean year, preferably 2.
Yeah. So I think the point that you're making is this: it's not enough to transform a company or to fix these certain things. You got to fix them, and then you got to show up in the financial results on the financial statements. Because I always say to people, there's a relationship between operationally how we run the business and the financial results. And so you're saying, hey, as a person who sells companies, I need at least 1 year, if not 2 years of great financials. And so obviously you've got to start, working on these issues before that, so it shows up in the financial statements. Yeah, really good insight.
And we'd have to prove, if you have a great increase for 1 quarter, it doesn't prove to the buyer that that's sustainable. So we need some time there.
Again, elevated risk, lower multiple of annual profits on the valuation. Hey, want to talk just a brief moment on, you've been in this industry for a while. You clearly sold a company, have regrets and lessons learned about better ways to sell companies. You rep companies all day long. Somebody's thinking about this and they say, man, I know that I want to sell a company, right? How do they go about selecting a transaction person? I mean, clearly, obviously, you and your firm work in a lot of places around the country, but what are the things that someone ought to be looking for to know that they're working with a really, really credible business broker or a great M&A advisor?
That's a good question. I would say, first of all, use one. Do not try that yourself.
Yeah.
Especially if we're in that M&A world, we will be dealing with attorneys and buyers that do this for a living. You want somebody that does it for a living representing you as well. So that's number one.
Yes.
Choose somebody. Don't do it yourself.
Okay.
Number two, and let's break it down. In the business brokers world, I would really quiz them on how many deals they've done and what their background is. There's a lot of business brokers out there that are very sophisticated. I'll just say it like that.
Yeah.
And
Let's dig into both of those. Volume, background. In your mind, how many deals a year evidences that somebody is really a competent professional, is going to be up to date? And then what are you looking for in the background?
And I'm looking a little bit less for number of deals and more. And I don't want to trash any of our competition here on
Yeah.
on the airwaves, but really what I want to know is, are they telling me what I want to hear, or are they telling me the right number, right? Because what we hear a lot of times, the first step in the process is valuation. We're going to value the company.
Okay.
And if I tell you a number, and once again, we're in the business brokers world, so sub $5 million, let's say I tell you it's $2.6 million. And you tell me, well, can you get me 3? The conversation looks something like, well, I'm on your team here. I'm not the one with the checkbook. I'm not the one to negotiate with. I'm trying to tell you what I think the marketplace is going to come back with, and we're going to be within 2 or 3 points. And we've gone a little bit higher. We're trying to capture the max. Right? So
Sure.
there are brokers that will come in there and tell them, oh yeah, we'll get you 3. They know they're not going to. They're just telling them they will. I get them to sign that listing agreement. Now they're locked exclusively with them for a certain amount of time. And so
Yes.
that would be the thing that I see a lot, is people tell them unrealistic things just to get them to sign up.
So clearly, evaluation is key, just like it is when you sell a house, right? We price a house too high, nobody's going to look at it. It's got to be priced at the right place to get the traffic and ultimately the offers. Coming to your background point, then clearly somebody has to understand how companies are valued. They got to have a process for doing it. They have to have access to databases of deal comps and all that sort of stuff. One of the things I've always found impressive about you and your firm, and I think it's listed right on your website, is the very high percentage of companies that you list that you actually sell. Tell us just super quickly how it is that you guys are achieving, I think it was over 90% success rates when 70% of companies that go to market don't sell. How are you doing that?
So it's 87% for last year. And
Okay.
a lot of the 13 is usually because something happened within the business that hurt the performance. But I would say that we do a lot of work up front. We do the valuation. We make sure that we're a really good fit with our client. And I like to say we're dating before we marry by doing that process. And we turn a lot down. Like for every 7 valuations, I think our number is we take 1 to market. We probably turn away half, 1 signs up and 2 sign up down the road.
Sure.
But doing that upfront work, we give them the number that we think it will sell for. And then we're looking for the things we just talked about. Is it ready to sell? Especially when it's a business brokerage deal, they may not have some processes in place. They may have some accounting issues. We're waiting through all of that. And if they have problems, we're going to tell them. And I think that's why we sell them, because we know what a deal is going to. It's not just the value of a deal. It's just like my dad taught me when I was 12 years old. It's going to sell. The value is what somebody will pay for it. And we know what somebody will pay for it, because when we value it, we look at it like it's not just comps, it's what would a bank finance, and how is this deal going to get done? I think that's the most important thing.
And I want to riff on that statement you just say. The value of the company is what somebody's willing to pay for it. Very frequently, I hear from owners, well, people are just going to pay what they're going to pay. What's your take on that? Because people use that statement to just justify not doing anything, as if there is nothing that they can do to maximize value or to prepare.
There's a lot of buyers, right? So for every deal that we take to market, we get 72 NDAs and financial statements. And we talk to each one of those. That's another thing that sets us apart. A lot of business brokers do not talk to each one of those. I'm listening for a lot of things. What I really want is a buyer that is reasonable, wants a business, has looked for businesses for a while, understands the game, understands that it's competitive, and is willing to go through the pain that it's going to take to get this deal done. And it's fair, right? You got a client that's owned the business for 25 years. I'm not looking for the buyer that's trying to steal the deal, right? So
Sure.
If we go through that work of talking to all those buyers, that's how we know that we're going to get that value, right? If we don't feel like we're going to get the value, or we can't put our finger on it, then we pass on that. So I guess to answer your question is, the value that we give you is what we think it would trade for, and we're probably right.
Sure. Yeah. Excellent. Hey, let's move.
Come back to answer your other question is we talked about business broker. How do you pick an M&A advisor? It's important to understand this space, because these are the people that a lot of times will try to do it on their own. You picture a person that's got a $10, $20 million company, they've got $2, $3, $4 million of EBITDA. They're obviously a confident person. They've obviously been successful. And so a lot of times they think, oh, a private equity company just called me directly. Let me run with this. Do not answer that call. Do not talk to them. Do not send them your data. Remember, I did this buy side work too. That's exactly what I wanted. I wanted to call and get the business owner. I didn't want to deal with Viking. Why? Because I'm going to have to pay more immediately.
Yes.
When we take a deal to market that's above $5 million, we do not put a price tag on it. We're trying to get an auction environment to maximize that amount of what the market will pay. Now, there's a lot of good M&A advisors out there, but I think the big, when you get into that space, the big thing is this is an intimate process. You need to like the person. Then you need to know that they're good, and you need to like the person. Investment banks can get in. The investment banks are. Well, let me back up one step. A question I get a lot is, well, do you have experience? Are you an expert in such and such an industry? And our take is, if you're selling a business for 10, 20, even maybe $40 million, there's not a lot of experts doing that, right? Because you've got to sell 50, 100, $200 million companies before you start specializing in certain spaces. So now, if I just sold an MSP, we've got 2 MSPs under contract right now. Okay, I know the MSP space, but
cool.
The big, so a lot of people are looking for somebody that has experience in their industry. I think that's less important than their process, how they go through it. So I would ask them their process. I would ask them, who's going to be representing my deal? Is it you, or is it going to be a junior guy that you're going to train with my deal? I would ask them that. And I hear a lot from clients that, a lot of people call me, you're the first person that's ever come and sat down in my office. So don't do a deal with somebody that didn't come and sit down in your office. I'm old school. I want to shake your hand. I want to walk around your facility. I want to know everything I can know. So I would look at those things as I was examining who to use.
That's great. Really great advice. Let's pivot maybe to a last topic before we close and we wrap. And that is, how do we maximize our net proceeds in a transaction? And you and I had a conversation, and I want to sort of bring this up around balance sheet issues, around net working capital, around fixed assets. What are the places that you see people not prepare, and so they give up additional net proceeds in cash? And conversely, what are the things people can do to prepare where they can maximize, as an example, what they're going to take away from the transaction?
That's a good question, and I think it's important to back up one step, back to the terms of a deal. Remember, I talked about cash-free, debt-free. So the cash in the bank is yours.
Okay.
And now, when you get into, you use net working capital. Net working capital, and you're a CFO guy, so maybe you give a definition to them about tell them what net working capital is for a second, because you'll give a better definition.
Net working capital traditionally is calculated as current assets minus current liabilities, correct?
Yeah. And so that includes what we talked about earlier, works in process. It includes inventory.
Yeah.
It includes
and for our non-finance folks listening to the call, current assets is as opposed to long-term assets. So current assets are things that we can access. Current liabilities are, debt payments are going to be due in less than 12 months. Or on the asset side of the house, we're talking about cash. We're talking about accounts receivable. We're talking about inventory, right? Yeah. These are sort of short-term liquefiable assets, short-term less than 1 year debt. Back to you, Jackson.
Yeah. So take cash out of the equation. When we're looking at net working capital, it's typically inventory or works in process, accounts receivable, those kind of things.
Yeah.
The current liabilities are typically accounts payable or maybe some payroll liabilities and things like that.
Could be a line of credit at the bank, could be accrued expenses like payroll. Yeah.
And so we take that, all of that stuff transfers to the buyer, right? And so it's important. And how does that transfer over? Well, we're going to do something called a net working capital peg. Net working capital peg is backwards looking. And we're going to say this company over the last, and this is done when the deal's under contract, with the buyer together with us. Is kind of a project to, let's figure out what our net working capital peg is together. But we have to, the only way to do it, we don't just make it up. We go back and look at the balance sheet over the last 12 or 24 months.
Got it.
And we're saying the company has been running a net working capital of X amount, right? And that's going to be our net working capital peg. Now, that it's obviously moving target. So let's just use round numbers again. We're doing a $10 million enterprise value deal, and we've decided there's a $1 million net working capital peg. And the way that works is, so at closing, the seller has to deliver the $1 million of net working capital. This is to keep everybody honest, right? Sellers don't want to call up all their receivables and get them to pay real quick for a discount because the cash is theirs. All those, you can't, it's to keep manipulation out of the game. Then it's not really to have money exchange hands, but it's this $1 million peg. Sometimes there'll be a buffer, 5 or 10% on either side of that peg. But if the seller delivers more net working capital, they get paid the difference. And if they deliver less, the buyer gets the difference. Comes out of the seller note or something like that. Now, the important, and then let me touch on one other thing. Fair market value of the assets, all that. The assets, the hard assets, the bulldozers, the truck, whatever they have, that also goes with the deal. You cannot sell a business a la carte. If you're selling at a 5 or 6 multiple of cash flow, you don't sell the inventory or the assets in addition to that. The buyer is going to need everything that has been producing that cash flow. So once again, how do we look at the number? How do we look at the assets that need to transfer? We look at what's there. Everything on that yard or everything in that shop. Here's a list. It goes with the deal. So a couple of things that you can do to prep. And once I get it, prep is out the window. It is what it is, right? So with somebody like you, if you're in there working with somebody a couple of years out, I would look at a couple things. Number one, what we call it an appropriate amount of inventory, an appropriate amount of net working capital. Don't overstock your inventory if you don't need to. And I know some people in the small business world do that out of comfort or out of lack of manpower or whatever. But if you have overstocked inventory, excess inventory, that's a hard negotiation for me to get you to keep any of that. If it only takes you, if you can do this with 500,000 of inventory, don't keep 750,000 of inventory. So that's one. All of your, and that goes across the board in all of your net working capital.
Cool.
On the assets, I think that it's important to look at the utilization rate of each asset, and is it actually getting you a return? We see quite often where somebody has a lot more assets than the benchmark industry standard, which just to stereotype our client, a lot of business owners don't like to be beholden to somebody else, so they want to keep. If I ever use a forklift, I'm going to keep a forklift, and maybe they use it once a year, but they're going to keep it.
They would be better off selling it and going and renting it day by day.
Correct, because when you sell the forklift, you get the cash.
There's two things I'm hearing from you. The thing one is, if you're looking back and calculating working capital pegs as far back as 24 months, anybody who is coming up on a 24-month window to sell their company, they really need to be addressing these issues, and certainly folks even shorter than that window. But one, we want to get more efficient. Hey, how can we reduce the amount of assets on the balance sheet, whether it's working capital or whether it's fixed assets, and still generate a similar amount of profitability? But then the second piece, and I think I've talked to you about this recently, is, sometimes owners own all these assets free and clear. And they oftentimes would be better off, depending upon the valuation of their multiple, of reducing EBITDA, going out and leasing or debt financing all these things and liquidating all that cash off the company balance sheet. They'd actually make out better in the long run. I have a client right now that they'd probably profit over $1 million by doing it that way, as opposed to selling the way that they are.
Yeah, when it comes to the balance sheet and all these topics, this is where they need to talk to somebody like you, because most of those scenarios where you're trying to figure out what is the right amount of inventory, what is the right amount of assets, how should I finance these assets? That's not an easy answer.
It's not. Jackson, it's been a great convo. I know we're pressing to the close. Tell folks how they can connect with you. If somebody's listening to this and they say, hey, I know that I'm prepping for a transaction, I'm looking forward to a transaction here in the next 12 months or even the next 5 years, and they want to connect with you, how would they go about doing that?
Go to our website, vikingmergers.com. You can get a lot of education there, but also, shoot me an email directly to jpayne, Payne, at vikingmergers.com, and we'll set up a call right away.
Awesome. Well, Jackson, it's so good to be with you. It's been a great conversation. I love some of the insights you shared with us just around deferred comp, deal structures, how to maximize things, even your own experiences of, lessons that you've learned through selling your family generational business. So thank you so much. It's been great to spend some time with you.
Thanks for having me on, Micah.
Thanks for joining us on Legendary Exits. We hope you enjoyed the conversation. If you did, give us a 5-star review on your favorite podcast platform, and be sure to subscribe to the show to stay connected with more stories of purpose-driven exits. You can find more information at legendaryexits.com. Until next time.